David Schwartz just utilized fundamental mathematics to demonstrate that the market believes your $100 XRP predictions are incorrect. And what's particularly fascinating is he articulated the exact same type of analysis 3 weeks before the 2017 rally that took everyone by surprise. Now listen, if you clicked on this video, it's because David Schwartz just issued a statement about XRP's price that has the entire cryptocurrency community talking and debating. And with XRP trading where it currently sits right now, you absolutely need to hear this analysis and understand what it actually means. Most people assume that whenever Schwartz discusses price, it's inherently bullish. Another indication we're headed to astronomical levels. Another justification to hold even more aggressively. But here's what absolutely nobody is telling you clearly. Schwartz just employed basic mathematics to demonstrate that the market itself is not pricing in the $100 XRP narrative the way Twitter and social media claim it is. And once you comprehend the underlying logic, you'll recognize that the smartest capital in cryptocurrency thinks very differently than the loudest social media accounts do. In the next few minutes, I'm breaking down exactly what Schwartz articulated, the mathematical framework behind it that you can verify yourself independently, the historical pattern that makes this even more intriguing, and why it matters right now with major Federal Reserve Chair news moving the entire market landscape. And look, I've been covering Ripple and XRP for years, almost a full decade at this point. I've observed Schwartz make these exact types of measured analytical statements before major market movements, and I'm going to show you precisely why that historical context matters significantly. Let's dive in and get into the substance. Markets experienced a little beating yesterday, correct? Still hovering around a $3 trillion total market capitalization. Bitcoin still maintaining above the $80,000 level. Ethereum a little off pace from that $3,000 psychological hurdle, and XRP sitting around 176. I want to show you the chart because I told you I'll be displaying this to you every single day without fail. No edits, no modifications, complete transparency. The RSI is the component I care about most, positioned down at the bottom of the chart. Purple crosses yellow. We kissed that level and then we experienced rejection. We're in bearish territory currently, RSI hovering around 34. If we break beneath 30, that's when you're entering into extreme bearish territory, and you typically start witnessing those panic flush events. But I've had these blue arrows positioned here for months at this point. I communicated to you the move was coming downward. People want to fight that analysis. They want to debate me. They want to inform me I'm wrong. They want to tell me I'm crazy and out of touch. Look, I'm realistic about market movements. This isn't about being right or wrong for ego purposes. It's about controlling your emotions and mapping the possible outcomes so you're prepared mentally, not surprised and reactive. You can observe these upper targets on the chart clearly. This $1.60 range, 1.40 range. Could it travel there? It absolutely could. But there's no logical reason to obsess over the moon targets when we have genuine hurdles and real support levels to deal with first in the immediate term. I'm watching the next two major hurdles before I spend all day daydreaming about extreme targets. And then after that, after the bounce, after the rebound to the upside materializes, yes, I am genuinely expecting a new all-time high on XRP. That's what I'm paying close attention to. That's the realistic roadmap. Realistic price levels, realistic market reactions, and emotional discipline throughout the process. And by the way, that chart and the RSI indicator are included in every single video right at the beginning so you can observe it for yourself and verify what I'm saying. Now, real quick, important note, ITR Capital. If you are genuinely nervous about these market conditions, if you think the situation is deteriorating, if you're worried about holding your cryptocurrency, worried about being hacked, clicking a malicious link, you need to get serious about how you custody your digital assets. Open an ITR account immediately. Stop debating it and delaying. It's completely free. No monthly maintenance cost. The only fee you get charged with is when you sell, just like any traditional exchange. And their fees are actually lower than the major exchanges. And if your wallet or account ever got compromised by bad actors, the only thing they can possibly do is cash it out directly into your verified bank account. That's it. They can't send it anywhere else. This is the same institutional grade custody that major players are utilizing, and they're US-based with proper regulatory compliance. Use my link if you want to. It helps support me and it helps you out simultaneously. You get free money credited with it as a bonus. Now let's discuss the Federal Reserve Chair situation. Looks like today Trump is going to make his official announcement for the new Fed chair position. Everyone wanted the individual from BlackRock. That's not going to happen, and that's okay. Looks like Trump's going to nominate Kevin Warsh. I don't know him personally, but his odds jumped up significantly in prediction markets. So I did what you would do if you were being diligent. I asked Claude AI, talk to me. Tell me about this individual. What do we know? Is he favorable for cryptocurrency? Historically, not particularly great for crypto, not particularly great for aggressive rate cuts. But here's the key insight. Stances change when incentives change. If this nominee wasn't aligned with where Trump wants interest rates to go, Trump wouldn't nominate him in the first place. And what we're witnessing in recent commentary is a noticeable shift. Warsh has argued for lower interest rates recently, pointing to productivity gains and disinflationary forces that could justify more aggressive rate cuts. And that right there is what this market is sniffing out and anticipating. Liquidity, rate cuts, risk on capital flows. And yes, cryptocurrency tends to be the ultimate risk on asset class and liquidity sponge when capital starts flowing freely. The market reaction yesterday, it didn't appreciate uncertainty. But all it takes is the new chair to come in and signal lower rates are coming. And you'd be genuinely shocked how fast market sentiment flips completely. Bitcoin can drop on fear-driven selling and then rip higher on a single line of dovish guidance. We've all witnessed it happen repeatedly. Now let's get into David Schwartz. David Schwartz finally discussed price again, and people are spinning it in every direction imaginable across social media. You've probably seen the tweet circulating. You've probably read 100 different hot takes on it. Here's what he actually stated in plain English and why it's considerably smarter than it initially sounds. He said, and I quote, "If many rational people believed there was a 10% chance XRP hits $100 within a few years, they definitely wouldn't sell very much today at much less than $10. Now pause for a moment. Let's break down why that statement is absolutely genius from a mathematical perspective, because this isn't a FOMO tweet designed to pump prices. This isn't buy the dip emotional manipulation. This isn't XRP to the moon hype. This is basic expected value theory and market mechanics working exactly as they should. If you truly believed, like genuinely believed with real conviction, based on analysis, not just vibes and social media sentiment, that XRP had even a 10% probability of hitting $100 in a few years, you would not be casually selling it for $2 or even $5. You would be accumulating aggressively. You would be treating anything sub $10 like an absolute gift from the market, because that's not just a possible upside scenario. That's a probabilistic bet with huge convexity and asymmetric returns. And Schwartz continues with the component that most people don't fully appreciate or understand. He states that those with that belief would quickly buy up most of the available XRP because they'd value it more highly than those without that conviction. And soon the supply of XRP available below $10 would dry up completely. That's the critical key to understanding this. He's describing a simple market process that happens automatically. If there's a meaningful cohort of rational market actors who assign a non-trivial probability to a massive upside move, they'll bid aggressively for supply. They'll absorb available supply. That's what efficient markets do naturally. That's what order books reveal about true conviction. And if enough smart capital is truly convinced of that probability, the cheap coins disappear from the market. His conclusion is the part that stings people emotionally. The fact that the trading price is well below $10 currently suggests there aren't very many people who actually think XRP has a 10% chance of hitting $100 within a few years. At least not enough rational actors to put serious capital behind that belief. Translation that matters. The market is voting with actual capital, not comments and tweets. And the vote says those $100 price calls are mostly social media noise without capital backing. Now, before anybody gets emotional and defensive, let me be absolutely clear about what this means and doesn't mean. This does not mean XRP can't rally substantially. It does not mean XRP is dead or worthless. It does not mean Schwartz is bearish on the asset. What it means is that right now, the market's aggregate pricing mechanism implies lower probabilities for that extreme target in that short time frame than the loudest voices on social media suggest. And you can perform this mathematical analysis yourself with any target, any time frame you choose. $10, $20, $50, $100, doesn't matter. If you really believed a specific distribution of probable outcomes, your buying and selling behavior changes accordingly. And collectively, the market becomes a probability aggregation machine. It's not perfect in its predictions. It's not always correct, but it's always revealing true conviction through capital allocation. And that's why this matters so tremendously in a market absolutely drowning in noise. Because it separates the people who are trading narratives and stories from the people who are trading probabilities and expected value. I'll be honest and transparent. My price projections have always been straightforward and basic. I've stated $4 to 650, and then we can discuss higher time frames and targets. People tell me I'm crazy for being conservative, but the crazy part is pretending $4 to 650 doesn't matter significantly on the way to $100 if that's the ultimate destination. Simple mathematics tells you it does matter. 4 comes first sequentially, then 5, then 6, then 7, then 8. That's how price discovery works in markets. You don't teleport past levels. Now, here's the part where it gets genuinely wild and historically interesting. Someone posted compelling evidence that Schwartz said almost the exact same type of measured analysis 3 weeks before the December 2017 rally. And that's the last time XRP went truly parabolic into all-time highs that defined its reputation. I know some of you will counter, but we had a big run more recently in 2021. I get it and acknowledge that. I'm talking about that legendary move, the one that defined XRP's public mythology and brought massive mainstream attention. So what does that historical parallel tell us that's actionable? First, Schwartz being rational and measured is absolutely not bearish or negative. It's honest and intellectually rigorous. The man does not pump prices. He never has throughout his entire career. Even right before the biggest rally in XRP's entire history, he wasn't out there screaming $589 tomorrow on social media. He was talking like an engineer would, discussing probabilities, mechanics, and reality-based scenarios. Second, and this is crucial to understand, he's also noted repeatedly that the most significant bull runs tend to be driven by unpredictable external changes that nobody sees coming. Now think carefully about what that means for current market conditions. In 2017, the external changes were retail mania, mainstream media attention, easy monetary policy, FOMO flows, and a market structure that could squeeze violently because liquidity was thin and the hype was extraordinarily thick. It wasn't mathematical modeling, it was oxygen hitting a fire and exploding. So the pattern isn't Schwartz is bearish, rally canceled, doom incoming. The pattern is Schwartz stays rational and analytical, and the market can still go absolutely nuts when external catalysts flip the switch dramatically. That's the real lesson worth internalizing. Because right now we're in a similar kind of environment where external catalysts matter more than any single tweet or social media post. Regulatory clarity developments, institutional infrastructure rails, market structure changes, macro liquidity signals, even something as simple as Fed chair messaging and guidance. Yes, that can change risk appetite extremely fast in modern markets. The market is forward-looking and hypersensitive to signals. So if you're watching XRP and you're only thinking in terms of arbitrary price targets without context, you're missing the real game being played. The real game is what catalysts change the probability distribution that the market assigns. What shifts the market's willingness to pay up for exposure? What moves XRP from speculative retail hold to institutional allocation and treasury asset? That's what actually changes prices sustainably over time. Because here's the uncomfortable truth that many don't want to acknowledge. Markets can ignore fundamental truth for a long time and then reprice everything in a single week. That's why retail traders get wrecked repeatedly. They're arguing on Twitter about who's right, while the order book tells the real story about where capital is actually flowing. And speaking of the real story, let me add something that will make this genuinely actionable for you in your decision-making process. The reason Schwartz's logic hits so hard is because it forces you to separate belief from actual positioning. You might believe XRP can go to $100 someday in the future. Cool, that's fine. But the market cares about what probability you assign to that outcome, what time horizon you're working with, and whether you're willing to buy, hold, and not sell when it becomes uncomfortable and the price drops. Most people don't actually have a probability model or framework. They have a mood that changes, and the mood changes with every red candle they see. That's why you see people screaming generational bottom opportunity at $2 there and then panic selling in fear at 170. They didn't have an actual plan based on analysis. They had a fantasy based on hopium. So if you're going to be invested in XRP or any cryptocurrency, your edge is not predicting the future perfectly with precision. Your edge is building a decision-making framework that keeps you consistent when the market tries to emotionally hijack you and force irrational decisions. The real difference between average investors who struggle and the ones who change their financial life is having a repeatable blueprint and a systematic approach for spotting high potential setups before the crowd shows up and drives prices higher. That's why I built the 100X Club specifically. Inside, you get the XRP Millionaire Blueprint, a clear framework for conviction, catalysts, and risk management so you don't get shaken out by normal volatility. You also get exclusive weekly stock alerts with high upside opportunities, plus the exact reasoning behind each idea. So you're learning to grow your wealth systematically. If you want access, it's in the pinned comment below. All right, back to the core analysis. Let's bring this home with proper synthesis. We've got Schwartz using basic mathematics to demonstrate that market prices reveal true conviction levels. And right now, the market is not pricing in a near-term $100 XRP outcome the way Twitter claims it is. That's not hate or FUD or negativity. That's a simple, honest read of supply and demand dynamics. If enough rational capital truly believed there was a meaningful probability of $100 within a few years, the price likely wouldn't be sitting way below $10 currently. The order books would look fundamentally different. But we also have the historical context that makes this even more interesting and worth paying attention to. Schwartz was measured, rational, and mechanical even 3 weeks before the 2017 parabolic run, which tells you his analytical tone isn't a signal that nothing's coming or that rallies are impossible. It's just who he is authentically. He's not a hype guy. He's an engineer who thinks in probabilities. And then there's the final key component. He's repeatedly pointed out that the biggest bull runs are driven by unpredictable external catalysts that change market structure. That is exactly why macro conditions matter tremendously. That is why regulatory headlines matter. That is why liquidity shifts matter. And that is why this Fed chair announcement matters more than people realize. You can hate politics all you want, but markets don't care what you want or how you feel. Markets care about interest rates, liquidity conditions, and risk appetite among participants. So the smartest take here is not binary bullish or bearish. It's rational and probabilistic. It's understanding that price reflects aggregate probabilities assigned by market participants. It's understanding that external catalysts can reprice those probabilities extremely fast when conditions change. And it's understanding that Schwartz being measured and analytical doesn't cancel potential rallies. It just reminds you not to confuse social media hype with market reality. So while everyone else is arguing emotionally about price targets and moon dates, you now understand the actual mechanics at play behind the scenes. Let me add some additional context about why understanding this distinction between narrative and probability matters so much for your actual returns. When Schwartz talks about rational actors and expected value, he's describing how professional capital thinks. Hedge funds, family offices, institutional allocators, they don't trade on vibes. They trade on probability-weighted outcomes. They calculate expected value. They size positions based on conviction levels and risk-reward ratios. When retail traders see $100 XRP predictions, they often think in binary terms, either it happens or it doesn't. But professional capital thinks in distributions. What's the probability distribution of outcomes? What's the expected value? What's the risk-adjusted return? What's the optimal position size given uncertainty? This is why order flow matters. This is why examining what smart money is actually doing matters more than what loud voices are saying. The current price action around 1.76 tells you something important about aggregate market beliefs. It tells you that while some participants believe in higher prices eventually, the collective weight of capital isn't positioned for imminent parabolic moves to $100. That doesn't mean it can't happen. Markets can reprice rapidly. But it means the base case probability being priced in right now is considerably more modest than social media suggests. The Fed chair situation illustrates exactly the type of external catalyst Schwartz references. When Kevin Warsh gets confirmed, when he signals on interest rate policy, when the market understands the liquidity trajectory, that's when probability distributions can shift dramatically. That's when the entire risk curve can reprice. That's the kind of external change that drives sustained moves, not just intraday volatility. Think about what happened in 2017. The external catalyst wasn't XRP-specific news. It was a perfect storm of retail FOMO, easy global liquidity, mainstream media coverage creating awareness loops, and thin order books that allowed violent squeezes. Those conditions created an environment where price discovery happened in days, not months. We went from obscurity to all-time highs in a compressed time frame because the external environment changed fundamentally. Right now, we're potentially setting up for a similar kind of external shift, but the catalysts are different. Instead of retail FOMO, we're looking at institutional infrastructure, regulatory clarity, potential ETF approvals, and integration into traditional financial rails. Instead of thin order books, we have deeper liquidity, but also more sophisticated participants. The mechanics will be different, but the principle remains. External catalysts drive sustained repricing. The RSI chart I showed you earlier matters in this context because it reveals market structure and sentiment extremes. When RSI drops below 30 into extreme bearish territory, it often marks capitulation points where weak hands exit and smart money accumulates. We're at 34 right now, approaching that zone. This doesn't guarantee immediate reversal, but it does suggest we're entering a zone where risk-reward becomes more favorable for patient accumulators. The 160 to 140 range I mentioned represents key support levels based on previous price action and volume profiles. If we test those levels and hold, it would confirm strong demand at lower prices, which is exactly what you want to see before sustained rallies. If we break through, we might see that panic flush to even lower levels before finding a bottom. Either way, understanding these levels helps you position appropriately rather than reacting emotionally. The custody conversation with ITR Capital isn't just a sponsor message, it's genuinely important for capital preservation. One of the biggest risks in crypto isn't market volatility, it's security. People lose more money to hacks, phishing, and operational errors than to bad trades. Having institutional-grade custody that limits withdrawal options to your verified bank account eliminates entire categories of risk. This is how you protect capital, so it's there when opportunities arise. Back to Schwartz's framework. The beauty of his expected value argument is that you can apply it to any investment decision. Before you buy or sell, ask yourself, what probability do I genuinely assign to various outcomes? What's my expected value calculation? Am I acting on analysis or emotion? This simple framework prevents most catastrophic mistakes because it forces conscious decision-making rather than impulsive reactions. The historical parallel to December 2017 is worth examining deeper. 3 weeks before that rally, Schwartz was making similar measured statements while social media was already hyping extreme targets. The rally came not because he turned bullish, but because external conditions shifted. Crypto entered mainstream consciousness, CNBC was covering it, your uncle was asking about it, and FOMO became self-reinforcing. That's the external catalyst he talks about. Could we see something similar now? Potentially, but the catalysts would be different. Instead of retail FOMO, it might be institutional adoption. Instead of CNBC hype, it might be regulatory clarity enabling treasury allocations. Instead of thin liquidity creating squeezes, it might be sustained bid pressure from institutional flows. Different mechanism, potentially similar outcome if conditions align. The key is not to confuse the absence of current extreme bullish pricing with the impossibility of future rallies. Markets are forward-looking, but also uncertain. They price in base case scenarios while leaving room for tail events. Right now, the base case isn't $100 in the near term, but base cases can change rapidly when new information arrives or catalysts materialize. This is why the 100x Club framework focuses on catalyst identification, not just price prediction. We map potential catalysts, assign rough probabilities, and position accordingly. When catalysts materialize, we're positioned. When they don't, we're not overexposed. This systematic approach beats emotional trading every time because it's based on frameworks, not feelings. The next few weeks are genuinely critical because multiple potential catalysts are converging. Fed chair confirmation and policy signals, potential regulatory clarity on digital assets, macro liquidity conditions, and XRP-specific developments around institutional adoption. Any one of these could shift probability distributions. Multiple catalysts aligning could create the kind of external change Schwartz references as driving major moves. So here's your action plan based on this analysis. 1. Understand that current pricing reflects modest near-term expectations, not zero probability of rallies. 2. Watch for external catalysts that could reprice those probabilities, especially Fed policy and regulatory developments. 3. Use technical levels like $1.60 to $1.40 support as reference points for positioning. 4. Maintain emotional discipline by separating belief from probability-weighted positioning. 5. Protect your capital through proper custody so it's available when opportunities materialize. These next few weeks are going to be critical for price discovery and direction. Let's navigate them together with actual information and analysis, not emotional reactions. Quick reminder, if you want the 100x Club with the XRP Millionaire Blueprint and exclusive weekly stock alerts with detailed reasoning, it's in the pinned comment below. And as always, like this video, subscribe to the channel, and turn on notifications because you absolutely do not want to miss what happens next. The setup is there, the catalysts are potentially aligning. The question is whether you're positioned appropriately when conditions change. Thanks for watching, and I'll see you in the next breakdown.